Hi, everyone. Welcome to the APPAM webinar, The Impact of Student Loan Debt on the Workforce. I'm Tara Sheehan, the Executive Director of APPAM. I'll start off with some housekeeping notes and then introduce our moderator. The webinar is being recorded, so if you can't stay for the whole webinar this afternoon or you're not able to join us live, you will be able to access the recording later. Visit appam.org for recordings of all our webinar content. We encourage questions, so please ask them at any point during the webinar by using the box on the right-hand side of your screen. During the Q&A portion of the webinar, I'll pass them on to the moderator. Let me introduce our moderator for today's webinar. Bridget Terry-Long is the Dean and Saris Professor of Education and Economics at the Harvard Graduate School of Education. She is an economist whose research focuses on the impact of affordability, academic preparation, and information on college student access and success. Welcome, Bridget.
Thank you, Tara. And again, welcome to the APPAM webinar, The Impact of Student Loan Debt on the Workforce. I want to thank the Association for Public Policy Analysis and Management, or APPAM, for organizing this event. I'll start by introducing the panelists. First, we have Kristen Blagg. She's a research associate in the Education Policy Program at the Urban Institute. She has conducted studies on student transportation and school choice, student loans, and the role of information in higher education. In addition to her work at Urban, she is pursuing a PhD in public policy and policy administration at George Washington University. She holds a bachelor's degree in government from Harvard University, a master's in education from Hunter College, and a master's in public policy from Georgetown University. Next, we'll have Leslie Turner. Leslie is an assistant professor of economics at the University of Maryland. She's also a faculty research fellow of the National Bureau of Economic Research and a faculty associate of the Maryland Population Research Center. Her work examines how incentives built into the current structure of the financing of higher education affect students and colleges, and the implications of these responses have for students' educational outcomes, loan debt, and labor market outcomes. And then finally, we'll have Michelle Miller-Adams. She's a senior researcher at the W.E. Upjohn Institute for Employment Research. Her work focuses on the national movement to create tuition-free college programs within local communities and states, and she has written 2 books on the topic. She's also currently examining the workforce outcomes of PROMS programs with a grant from the Strata Education Network. Miller-Adams is also a professor of political science at Grand Valley State University. And with that, I'm going to provide an introduction before we'll hear from each one of our panelists. To begin, I imagine many of you are interested in this webinar because you've heard or have learned or studied the amazing growth we've had in student loans. There has been tremendous growth in the number of individuals who are taking out student loans, as well as the total amount of debt that has been taken out. This is often influenced by the size of the cohort coming into higher education, as well as the increasing propensity for students to attend from lower income backgrounds. Meanwhile, we see the average amount that is being borrowed is growing, while repayment rates are declining, and this is something we'll explore during the webinar. To go to the next slide, I want to provide some basic trends and statistics. Starting with providing some background from the College Board Trends and Student Aid Report from 2017. You can see how the total amount of student loans has evolved from 1996-97 school year to the 2016-17 school year. I want to note that this is already taking into account inflation by putting in constant 2016 dollars. And you can see the loan portfolio is made up of multiple parts, with the bulk coming from federal sources. That's the federal subsidized loans, that's for students who are lower income, the federal unsubsidized loans that are available to all students, and then the Parent Plus loans, which are also federal loans for parents to help take on some of the expenses for their students. You also have Graduate Plus loans for those who are graduate students, the Perkins loans, and then non-federal loans there at the top. I should note, though, that we have limited information on non-federal sources, and you can see the bulk of the trend data we have is based on federal sources. As shown in this graph, you can see the peak in the 2010-2011 school year, which is the combination of having a very large cohort, the largest cohort of high school graduates coming out in 2008, combined with the recession sending many back into schools to do retraining. And since then, you see slight declines in the total amount as we've worked through the system and many people have gone back to work. Going to the next slide, though, we can see how this is impacting individual borrowers. So the top part shows the average amount that undergraduate borrowers are taking out from 2001 school year to 2016 school year. And in terms of subsidized and unsubsidized federal loans, the amount has only increased slightly. This is partly due to the fact that there are loan limits in the amount of loans that can be taken. But the bottom graph shows you see increasing amounts from 2001-02, about $11,000 on average per undergraduate borrower, rising to almost $16,000 by 2016-17. Again, with these federal plus loans, which are loans that parents can take out to help pay for their child's education if they have the financial credibility to do so. Going to the next slide. When we take this all together to try to understand how much debt individual students have and how that's distributed through the system, this graph gives us a sense of that. While we oftentimes hear in the press the significant number, we oftentimes hear about students who have significant amounts of debt, or $100,000 or more. What you can see is that the relatively small percentage of borrowers overall, only about 5% of borrowers have more than $100,000 of debt. The bulk of the system, we're dealing with borrowers that have less than $10,000 of debt. That's about one third of students, or 57% of students having on average less than $20,000 in debt. So often, as we've done more research, we've learned that in issues of the burden and the repayment, it's oftentimes not those very large amounts we hear in the press, but smaller amounts that borrowers are struggling to repay. And my last graph notes this. This is showing federal student loan, going to the next slide, please. This is showing federal student loan repayment rates by sector, comparing 2006-07 school year to the 2011-12 school year. And this is telling the story of declining repayment. You can see for each sector, going from left to right, starting with the public 2 years or community colleges, public 4 years, the private nonprofit 4 years, the for-profits, and then overall. The 3-year repayment rates have been declining in each sector, and you can see that overall, where in 2006-07, it was 57%, and by 2010-11, it's getting down to 44%. Repayment rates are especially low in the for-profit sector, but we also see repayment, borrowers struggling with repayment and the community college sector as well. And so this is telling us part of the story, whereas many borrowers do not have more than $20,000 in debt, they're still struggling to repay. And this has implications for how they are managing the labor market and employment and other kinds of outcomes, which we'll hear about from our panelists. I'd now like to transition to our first panelist. To conclude, the growth in student loans overall has been because more people are going to college, but realizing underneath this, as we've had more students going to college who are lower income, they have to rely much more on debt in order to be able to pay for college. And we also see that borrowing is growing faster than wages, which is increasing the individual debt burden, and we start to see a symptom of the problem when we see declining repayment. But a thing to keep in mind with student loans is there's a great deal of complexity with the system in terms of applying for the loans, understanding what responsibility you're taking on, what repayment options there are, and we've seen in lots of other literatures and even within financial aid that lack of information and complexity can lead to poor choices. And we know from the literature and from talking to students that oftentimes they're not quite sure what they've gotten themselves into or what their options are in terms of repayment. to keep this manageable as they move on into the labor force. And finally, we know, though, that federal and state policy also matters a great deal. Part of the growth in loans is explained by the fact that our federal aid, as well as often state aid programs, have not kept pace with rising tuition costs, and grants have also not increased in a considerable amount, meaning that debt is the only way for families to be able to make up the difference. We also see this at the state level, where state appropriations are declining, tuition rates are increasing, and so students increasingly have to look to student loans to try to make up the difference. So some questions for us to consider during this webinar, and the panelists will be speaking to, is what impact are loans having on student decisions and outcomes longer term? As they move through school and go into the labor market, how is it impacting employment choices and repayment choices? We'll learn a bit more about who is not able to repay and whether or not alternative repayment plans could possibly help. And then we want to consider what could be the role of policy to improve things, and also what role could research play in identifying effective ways of addressing these issues. So to give you an overview, we'll next go to Kristen Blagg, who's going to talk a bit about loan repayment and default. Leslie Turner will then talk more about student loans and the labor force. And then finally, Michelle Miller-Adams will give us the policy context. And with that, I'm going to pass to Kristen Blagg.
Thank you and good afternoon. My slides are going to actually pick up on many of the trends that Bridget was talking about. So first, this is just another way of visualizing the sort of starting student loan balance that borrowers have when they enter repayment on their loans. This slide in particular includes that roughly 10% of non-federal or private loans as well, but you see it doesn't really affect the trend much. Most borrowers still have loan balances that are relatively small, typically less than $10,000 or so. With a very small number of borrowers, mostly students who have borrowed Grad Plus loans with balances that exceed 6 figures. However, despite these relatively small loan balances, if we go to the next slide, we see that that many student borrowers still enter delinquency or default on their student debt. So to talk to this chart a little bit, this is a cohort of borrowers that entered repayment in 2012. And then this follows them over 4 years into checking up on them in 2014 and 2016. We see that the majority of borrowers stay current, about 60%, but many borrowers sort of go back and forth between delinquency and even into default. And so the next slides will start to unpack a little bit who enters default. So if we go to the next slide, those with low balances are the most likely to default. So about 32% of those with debt lower than $5,000 in this 2012 cohort ended up defaulting within 4 years. Default has consequences. You can have your tax refunds offset, and that includes things like your earned income tax credit. It can also obviously affect your credit score, and it can even result in wage garnishment, where up to 15% of your discretionary wages could be garnished. You'll also notice that while we talk and focus quite a bit on those who default, who have relatively low balances, there is still a likelihood of defaulting even up at the high balance end of things, and that would typically represent individuals who have perhaps multiple years of higher education under their belt or grad school. But we also note that most of the delinquency and default are in those lower categories. So if we go to the next slide, we can unpack this a little bit more. So one of the things that's most notable about these individuals that are entering default is their own financial status, their debt, in the year before they're actually entering student loan repayment. So individuals who are going to default in the year before they enter their student loan repayment, they already have higher levels of utility collections debt, medical collections debt, retail and bank collections, and they're less likely to hold forms of credit that would typically require some sort of risk analysis or verification, such as credit card debt, auto debt, and mortgage debt. The way that I read this would be that borrowers are already in, these borrowers who will default are already in some form of financial distress before they're entering repayment. And actually, if we track these collections data over time with their repayment status, utility and medical collections in particular rise up to levels of around 70% at the year of default. So a default happens, and it's likely that that is not the only debt that that the borrower is being negligent on. So when we are looking at the likelihood of default and the amount that might be controlled by data in sort of this credit bureau data set that I have, so monthly payment and balance actually don't particularly explain much of the likelihood of default. But holding other types of debt or collections, and the borrower's credit score, all in that year before the borrower enters repayment, are more likely to be associated with default. So on the next slide, of course, a borrower's individual financial background is not the only thing that is correlated with a likelihood of default. Judith Scott Clayton and others have done great work looking at the impact of where the borrower goes to school, or the borrower's racial and ethnic or socioeconomic background on default. So this first chart shows that even when you have controls for background characteristics, controls for amount borrowed, and even controls for income, you still see differences in default rates by the sector that the student attended. If you click through the next chart, similarly, when we introduce controls for the same characteristics, amount borrowed, background characteristics, GPA, and even job status and income after leaving the institution, racial and ethnic differences in default also persist. So on the next slide, default still occurs, but we actually have a lot of options to help student borrowers delay repayment or to repay based on the income that they're receiving. So the options include deferment or forbearance on loans, as well as income-driven repayment plans, such as pay and repay. But we do have some evidence that, as Bridget mentioned, these plans are complex. They require knowing about the plans and then knowing how to enter them. So there's some evidence that low-income borrowers may not take up these options as much as other borrowers. So on the next slide, on the next, so this is the sort of payment plan that a borrower is on based on their income. And you'll see that income-driven or income-based repayment is the most popular option among those with household income between 20 and 60K. However, you should also look at those gray bars there, which are borrowers who report that they're not making payments, either because they're in forbearance on their loans, they can't pay, they think they have an inability to make payments, or they're in some other loan forgiveness program that isn't income-driven repayment. And that option is most prominent among those with very low household incomes. Here, similarly, those who have sort of now the gray bar is black for reasons unknown, but similarly, those with lower levels of higher education are more likely to report that they're not making payments, and those with bachelor's degree or master's degrees are more likely to either be using income-driven repayment or be in some other repayment plan, such as a 10-year standard plan. And last but not least, but I think on the next slide, this is the most substantial finding, is that if we look at households that are receiving some federal benefits, such as SNAP, those borrowers are much more likely to just not be making payments on the loan, rather than relying on repayment options such as income-driven repayment, where they most likely would be eligible to make $0 payments on their loans. So the next slide. So one of the challenges for policymakers in reauthorizing HEA, or the Higher Education Act, will be to actually improve this process. So policymakers on both sides of the aisle have proposed new ways to reform income-driven repayment plans, and they may be more or less generous to borrowers depending on their levels of debt and also their income levels. Another ongoing question being debated by policymakers is whether enrollment in income-driven repayment plans should be automatic. So automatic upon entering repayment at all, or perhaps when the borrower reaches, say, 120 days of delinquency, that loan would then be moved into an automatic repayment plan. So if you want to understand more about how income-driven repayment plans work, I'm going to engage in a little bit of self-promotion. We've made an interactive tool that allows you to look at the distribution, essentially, of payment under different plans, which you can access on our website. It's called Charting Student Loan Repayment. All right, and I think at this point, I'm going to pass it on to Leslie Turner.
Thank you so much, Kristen, and thank you all for joining us in this webinar. I am going to be discussing what we know about effects of student loans on workers in the labor market, and also steps that employers are taking to provide services around student loans. But first, I'm just going to give a few examples of the discussion out there in the popular press around loan effects on workers. So in these two articles, we can see the discussion being that college may reduce entrepreneurship. College debt may reduce entrepreneurship. Student loans may lead borrowers to be less likely to start their own business. Student loans may make some people abandon their dreams or be constrained to take jobs that were not the jobs they intended to take. And then finally, on the next slide, we have a discussion that in a substantial minority of states, unpaid student loans may cause individuals to lose their driver's license or other licenses for particular occupations, further constraining their labor force options. And so in this part of the webinar, I am going to be focusing on what we actually know. Are these newspaper articles an accurate representation of what's going on, what the effects of student loans are on borrowers' employment decisions and constraints? And then I will discuss how employers have responded. And these are the two questions I'm looking at in the next slide. Okay, great. So if we can advance. So first, let's think about how having student loan debt might affect borrowers' labor market decisions. So first, we can advance. Borrowers might be constrained by a need to lower their living expenses and thus be constrained in terms of where they can live. And this in turn could affect what jobs they have access to. And in fact, there is evidence that individuals who have student loan debt are more likely to end up living with their parents, and this could affect, again, what types of jobs they have access to. The second bullet suggests that loans could affect where individuals can or have to work. So the need to service the debt may cause need to take jobs that pay higher or that involve less risk. Third, the presence of student loans, and then also the type of loan repayment plan that borrowers participate in could affect how much to work. So one consideration that needs to be taken into account thinking about these income-driven repayment plans that involve debt forgiveness is whether these plans provide disincentives for borrowers to work more and earn more, because some of those earnings are going to go to service the debt. And then finally, as one of the newspaper articles suggested, having student loan debt may affect an individual's decision of whether to start a business. So having student loan debt might increase the risk associated with entrepreneurship. And then the final point I'd like to make is that running around in the background of all of this is the effect of student loans on college completion and attainment. And we know college completion is very important when we're thinking about labor market outcomes. And so for this discussion, I'd really like to think about the effect of student loan debt holding constant college completion. So we're really looking at the effects of student loans rather than whether or not individuals with student loans are more or less likely to complete college. So in the next slide, I'm just going to discuss what we know from research on how student loan debt affects borrowers' labor market outcomes. One of the earliest papers looks at the adoption of a no loans policy at a highly selective university and finds that for students who just by luck were in cohorts that took on more debt because they entered before these no loans policies took effect, they were less likely to work in the public sector and they were more likely to take higher paying jobs. Consistent with this finding is a set of papers that look at older cohorts of borrowers. And these papers also find that those who held student loan debt were more likely to accept a lower paying job that was less related to their degree than non-borrowers. When it comes to effects of student loan debt on entrepreneurship, there's descriptive evidence that the counties where individuals hold higher levels of student loan debt or higher prevalence of student loan debt, there's less formation of small businesses. And then finally, the last study I'll talk about is looking at schools that have adopted these no loan policies similar to the school in the very first bullet point. And the authors find that when individuals attend schools that have adopted no loan policies, they're more likely to become entrepreneurs, and also they're more likely to receive venture capital backing to support their endeavors. And VC backing is often seen as a signal of a high quality entrepreneurship venture. Okay, so one thing I'd like to discuss next is the role of income-driven repayment. So income-driven repayment, which Kristen has already touched on, links student loan payments to a borrower's earnings. And in this sense, it can serve as insurance against unaffordable loan payments. And in theory, IDR participation in income-driven repayment has ambiguous effects on labor market outcomes. On one hand, it's going to reduce the immediate return to earning a lot because some of those earnings will go to pay the student loan debt. On the other hand, it could reduce, or it would reduce the downside risk of a highly uncertain but high return venture, such as starting a business. And then finally, income-driven repayment could improve the match between firms and employees by allowing the borrower to spend a longer time searching for the job that best fits their skills. So what do we know about the effects of income-driven repayment on labor market outcomes? In fact, we know very little. In the US, these plans have not been around all that long. Can we advance? But in Australia, one of the first countries to establish a national income contingent loan program, which is just another way of another name for income-driven repayment, there has been a finding of sort of very small reductions in earnings in response to incentives that are baked into the system. So when individuals reach the point where they have to start making payments through this income contingent loan system, they are some of them take action so that they lower their earnings. But this is sort of a very, very small effect in practice, and it isn't persistent over time. So based on the evidence from Australia, it would suggest that the effect of a national income-driven loan repayment system may not have huge adverse effects on labor supply and borrowers' decisions of where to work and how much to work. So finally, I'm going to talk about how employers have responded to the growth in student loan debt among individuals in the workforce. And this is going to be purely descriptive. To my knowledge, there hasn't been research looking at the effects of these employer responses, although this is an area that is ripe for investigation. So the first type of response on the part of employers is offering loan repayment benefits. Yes, you can advance. So this is often seen as a way to attract workers, to retain workers, to increase worker productivity. And if we advance one, we can see three examples of third-party firms that offer these loan repayment benefits. We advance one more slide. We can see all of the variety of features that these plans can take. So in general, these are going to be plans where an employer themselves or a third-party firm that is hired by the employer makes loan payments on behalf of the employee. These might be on a monthly basis. They might be all as a lump sum after a certain period of time. Most often, these are used to supplement the borrower's required monthly payments, but in some cases, they are made in place of the borrower's own payment. And most often these go to a student loan servicer rather than directly to the borrower. The second type of benefit that employers are offering to serve their employees who have student loans are financial wellness programs. And often these are offered in conjunction with loan repayment benefits. So this is just an example of an organization offering these types of financial wellness programs, Savvy, and they offer financial literacy, one-on-one support to get advice on things like the student loan repayment plan. They offer a website that sort of provides advice, assistance, information designed to help individuals make their loan payments do sort of take the best action that they can to deal with their student loans and with their other types of debt. So in summary, why might firms provide these benefits if we move to the next slide? So there's evidence that a lot of young workers report having a lot of stress around their finances and that this is a distraction from work. And so in addition to serving as a recruiting, retention, and productivity improving mechanism, these programs may reduce stress of employees and distractions and benefit the employer through these channels. Okay, in conclusion, I'm just going to talk very quickly about two additional considerations. So there's evidence that decisions around how debt is framed, even if it doesn't affect the actual debt or the actual repayment options, may affect borrowers' post-college decisions in an outsized way. And so the first study I'll talk about here is an older study that looked at law school graduates that were randomly assigned to receive one of two financial aid packages that were essentially the same. They were the same in value. But when the financial aid was framed as a tuition waiver that would convert to a loan if the borrower didn't go into public sector employment, the law school graduates were more likely to take public sector jobs than when this aid was initially presented as a loan that would then be forgiven with public sector employment. So this is exactly the same type of aid, but the way it was presented mattered a lot for the decisions of these law school graduates. In the second bullet point here, I will talk about one of my own studies that suggests the way that income-driven repayment is presented to borrowers, whether the costs or the insurance value is emphasized matters for borrowers' decisions to take up income-driven repayment, even if the underlying features of the income-driven repayment plan are exactly the same. And so in conclusion, if we can go on to the last bullet, please, and then the last one. I am going to draw from a report by the CFPB that looks at all these various ways employers are providing loan assistance and repayment benefits. And this report really highlights there's a lot of innovation going on, but the way that loans are currently paid and the interaction between third-party organizations and servicers dilutes and minimizes the effects that these employer programs can have. And there's a lot of just loss of benefits due to the complexity of the loan repayment system and the sort of specifics of how loans are serviced. And so I think this is an area that is ripe for further innovation and further research, and there clearly is a demand for loan-related benefits that are provided by employers. So with that being said, I'm going to hand off to Michelle Miller-Adams, who will talk about policy implications relating to student loans.
Hi, everybody. Thank you to the organizer and to my fellow panelists. It's nice to be here today. Always challenging to go in the cleanup batter position when you have great fellow panelists. But there are a couple of things that I think we can still talk about. I want to refer back to some of the comments Bridget made at the very beginning about how federal policy has helped contribute to the student loan debt problem. And I've decided to focus on federal policies rather than state policies, partly because I only have 10 minutes, but also because there are 50 states and the policies vary. We could have quite a long conversation about what is wrong with federal policy around student loan finances, but I wanted to touch today on 4 different issues. And many of you already know a lot about these issues, but they bear repeating. Issues related to the FAFSA, the declining value of the Pell Grant, the question of regulation of for-profit colleges, and the complexity of the public service loan forgiveness program. And then I want to end with some slightly more uplifting news about some promising developments at the state and local level. So there we go. This is a really fast-moving field. This week, I think pretty much every day this week, either a report came out or an article was written where I thought, this is perfect, we need to talk about it. So I will mention that APPAM has put together a resource page at the end of this presentation that has some of these links. So to start with FAFSA, we have kind of a status quo situation with FAFSA. FAFSA simplification efforts have been underway for many years with minimal results. The FAFSA process itself continues to be complex and difficult. There are a variety of simplification bills that are pretty much languishing. Some of the biggest problems, of which we're all well aware, are lack of student awareness of what they need to do and by when, missed deadlines. There's also some growing concern about the verification process, which is when you are asked to provide additional documentation about your FAFSA application. There was just an article this week in Inside Higher Ed noting that these FAFSA verification requirements are falling disproportionately on low-income and minority students. And of course, the results of all of this is that money is left on the table, and what could be federally supported Pell Grants are replaced with private loans. And that has certainly contributed to the situation that we've all been talking about today. On the bright side, we have one piece of good news, which is that you can now fill out your FAFSA on a mobile device as of a couple of weeks ago. So there's a picture of the app. So let's go on to the next slide. Here too, we have a little bit of a good news, bad news story. As you can see on the figure on the left, the amount of Pell Grants has recovered. This is, again, a real dollar 2016 dollar graph. So you can see that they reached their inflation-adjusted low in the mid-90s, and have since recovered. In fact, this year's Pell Grant has gone up $175 over last year, so the maximum Pell is now just over $6,000. But because of increases in the cost of tuition, as the figure on the right shows you, those Pell Grants are covering less and less of your college education. This particular graph is full attendance costs at an average of public four-year institutions. And you can see the tremendous decline. This chart resonates for me because I went to college in 1976, and my tuition at the University of California was $238 a quarter. So things have changed, and not for the better. So let's go on to the next slide. So this is an area where there is really very little good news. You have seen through some of the data that my colleagues have presented that default rates are disproportionately high at for-profit colleges. Student borrowing is higher at for-profit colleges. This first bullet point I find kind of interesting. For-profit subsidized student loans, and students at for-profits are more than twice as likely to default than those at public colleges. We saw some data, I think maybe from the College Board earlier on. This is some, or maybe it was this NCES data, but you can see the 52% default rate at for-profits versus the public four-year and community colleges. The current administration has made matters worse in the area of for-profit colleges by reversing some of the accountability measures that had been introduced in prior administration. Some of this is just a matter of staffing decisions at the Department of Ed and who has been brought in to kind of govern this sector. But there have also been some cases that have moved forward. So over the summer, Education Secretary DeVos announced the end of this gainful employment rule, which provided some recourse for students who had borrowed money based on false promises about the kind of education and job readiness they would be getting. Oh, back up, there we go. Okay, thank you. And there was actually some news about this week. There was a companion measure called the Borrower Defense to Repaying, which allowed students to have their federal student loans forgiven if a school employed illegal or deceptive practices to encourage them to borrow. This rule was supposed to take effect in July, had been delayed by the Department of Ed, and just last week, a federal judge ordered the implementation of this rule. So I guess there is a little bit of good news on this slide as well. So let's move forward to something else that has been in the news quite a lot, and coincidentally, there was a lengthy segment on Morning Edition this morning about this very topic, the Public Service Loan Forgiveness Program. This program offered loan cancellations to borrowers who committed 10 years of their postgraduate work life to public service. The idea is that borrowers in certain qualified positions, after they made 120 on-time loan payments, would become eligible to have the remainder of their student loan debt canceled. This program began in 2007, and the first borrowers became eligible last year. The bad news is that for a variety of reasons, almost none of these applications are being approved. These really shocking statistics came out quite recently. Out of almost 33,000 applications received by last June, only 1% had been approved. And there have been some articles put out recently about this. There's a lot of blame to go around, from the Department of Ed to the student loan servicing organizations. But all in all, this is a story of red tape, fine print, as Bridget said earlier, complexity leading to confusion and poor choices. There's an analogous program for teachers who serve in certain types of schools. It's called the Teach Grant. And in that case, 60% of the applications have been ruled ineligible and converted to loans. So this is a huge problem. Possible there'll be some action on this in the near term, and we should hope there is. So let's go to the next slide. So I want to just end with a couple of comments about my own area of research, which is the area of promise or tuition-free college programs. There are about 100 communities that have created these place-based scholarship programs, and about 17 states that have done so in recent years. These programs are motivated by a couple of different things, reducing the cost of college and increasing access, but also highly motivated, especially the state programs, by building a better prepared, better trained workforce. Most of these programs are last dollar and they cover only community colleges. And there are some pretty stunning examples of poor program design in some of the programs, real cases of complexity, fine print, and a lot of confusion on the part of students that's going to come back to hurt them in the future. But I want to end just by talking for a moment about the Tennessee Promise, which is on the next slide, which is an example of one of the better designed programs. This program was launched in 2014. It's a last dollar program that covers 2-year community colleges and applied technology colleges throughout the state of Tennessee. The scholarship comes with mentorship programs and very strong messaging. In part, that messaging has led Tennessee to becoming the leader in the nation in FAFSA filings over the past 4 years. In the first year, they had a 15% increase in FAFSA submissions. They have also seen a decrease in the take-up of student loans, presumably because more students are getting grants, and they saw an increase in their college going rate in the first year that has remained in place during the next 2 years. Just last year, the state of Tennessee supplemented the Tennessee Promise with a program called Tennessee Reconnect for Adults. And in year 1 of that program, which was this year, adult enrollment in community colleges and applied technology colleges has gone up over 17%. So backing up a little bit on the last slide, I wanted to kind of wrap up what we know. Next slide. About Promise programs. So we know that simple and transparent messaging matters, and the good news is that's something that's really cheap to do. We also know that the culture around college going and information and knowledge to make good decisions about college fit and finances can change as a result of these programs, and that's a change that does take some time. We also know from rigorous research that we've carried out here at the Upjohn Institute that more grant money can boost college enrollment and completion. This is, of course, expensive, but the money can come from Promise programs or colleges or the federal government or state governments, which have cut back on the amount of funding they provide to higher ed. And we also know that Promise programs can serve as effective tools to bring communities together and in particular to engage employers with higher ed institutions and even with K through 12 systems. This is hard work to do, but it's essential if your state or local Promise program is going to be truly transformative. Something we do not know yet, but we are beginning to study, is how Promise programs affect workforce outcomes, including things like long-term employment, earnings, debt, or location decisions. With some support from the Strata Education Foundation, several colleagues and in 4 communities, along with us at the Upjohn Institute, are beginning some research on this question, but we don't have any answers on that yet. So thank you for inviting me to share these thoughts with you. And I'm going to pass things back to Tara to facilitate any questions that people might have been submitting.
Hi, everyone. So this is the time to submit any questions if you have any, and we have a few thus far. Bridget, I'll throw it over to you. How does the 2007-2008 financial crisis relate to the debt increases observed over that 5-year period post-2008? Well, first, is there any connection between these two phenomena?
Okay, I'm going to go through the panelists. Kristen, do you want to first address that question?
Sure. So I think, Bridget, you talked a little bit about this in the beginning, but the 2008-2009 recession, did push a lot of people back into school, and going into school often would mean taking out student debt. I think more broadly, there's the question about job opportunities for people coming out of school, and I think this goes back to a lot of what we were talking about in terms of we know the unemployment rate for those holding bachelor's degrees and higher is relatively low, but for those who maybe went to a semester or two of school but didn't complete, having a weaker job market would certainly potentially affect repayment.
Leslie or Michelle, anything to add?
I actually would like to take this opportunity to mention a study that came out this week about employer-based education assistance programs. This is a study that came out from the Century Foundation. It's called Starbucks, Walmart, and Amazon Offer Free College, but Read the Fine Print. And it's just really interesting to look at what employers are doing now that the labor market is so much tighter. Back in 2008, employers did not really need to offer the inducement to go to college to their workers because people were desperate for jobs. Today, retention for entry-level employment has become such a challenging issue that educational employer assistance programs are something that large employers are offering to help attract and retain workers. But it's really important, and I think this analysis that the Century Foundation did does a great job of pointing out how many of these programs don't actually create more choices for their workers, but actually lock them into a narrow series of choices that may not be really helpful for them over the long run.
Okay, Tara, let's go to the next question.
Okay. How do the student loan trends affect employers' decisions about the benefits they offer? How does it relate to employer thinking about employee financial well-being in general?
Leslie, do you want to start with that one?
Sure, thanks. That's a great question. So there's been a somewhat of an explosion in employers' offerings relating to student loans. And I talked about this a little bit in my part of the webinar. So there's descriptive evidence of financial stress, that it affects productivity at work, it affects absences, and also that young adults who have graduated from college or left college are very interested in benefits that have to do with their student loans, whether it be financial wellness programs or these third-party loan payments that employers facilitate. And so employers are definitely responding to this. There's a large amount of interest in these types of programs, and there's likewise a growth in organizations that are offering these types of programs. And so I think this both represents employers' views that this is something that is useful in attracting and retaining workers, and then also the amount of stress and importance that young adults place on dealing with their student loans.
Okay, I want to give a chance. Did either of the other panelists want to jump in?
I have a bunch more questions if you want to do.
All right, let's go to the next one then.
Okay, can you talk about how last dollar promise programs are benefiting low-income students who receive full Pell Grants that cover tuition at community colleges?
Okay, Michelle, I think this one's for you.
I think this one's for me. That's a great question, and of course that has been very much in the news lately with a couple of reports that came out from EdTrust and IHEP, basically saying that these last dollar community college only programs do not really have a very good equity impact in terms of benefiting low-income students. I am sympathetic to that argument and have long argued that you really only change people's decisions and behaviors by changing their incentives, and that often means giving them some new money when it comes to scholarships. But as I've sort of observed this field and thought more about it, and also looked at the evidence from places that have these scholarships, these programs can actually be really beneficial to low-income students through three main avenues. One is the messaging around college going, that with a universal program, even if it's a last dollar program, tends to permeate the culture of the schools and the community and create expectations that everybody should and will go on to some kind of post-secondary education or training. That tends to bring people, low-income students who might not previously had considered college, into the process, and with strong FAFSA prep as part of those initiatives, those students are able to access Pell Grants that they would not have gotten otherwise. So yeah, I think I'm gonna stop with that point, but really the main issues are around messaging, cultural change, and accessing existing forms of financial aid. Those are ways through which these last dollar programs do benefit low-income students. Of course, we would love to see programs that, like the Kalamazoo Promise, that make scholarships available on a first dollar basis, and then low-income students get to add their Pell Grants on top of that.
Okay, great. Tara, next question.
Could everyone share their thoughts on across-the-board student loan cancellation?
I'm sorry, could you repeat that one time?
Sure thing. Could everyone share their thoughts on across-the-board student loan cancellation?
Okay, Kristen, do you mind going first?
Sure. So I think that broadly, like, there's a cohort of people that are currently supposed to be making repayment on their loans, but can't and haven't been for a really long time, because of financial circumstances. So broadly, I think if we thought about implementing some form of cancellation, perhaps for let's say if you've been on a means-tested benefit for a given period of time, maybe 5 or 10 years, that sort of is a certification of low income in such a way that their loans would be canceled. I think the sort of opening up floodgates of having broad student loan cancellation is potentially difficult because of the sort of moral hazard that we're introducing into the loan program. But I think there are lots of opportunities to think critically about ways that we can use loan cancellation for folks that for a long time have been unable to pay.
Okay, Leslie, would you like to build from that?
Sure. So I will talk a little bit about options to help borrowers who are struggling with payments, such as a wider scale, easier access, income-driven repayment program. So this is the type of program that would help borrowers smooth over shocks to their income. For those borrowers who had persistently low income, they would essentially effectively have their student loan debt canceled because almost all of these types of repayment plans do not require payments if income falls below a certain level. And at the same time, those who benefited from taking out student loans and going to college and getting a degree and getting a better job would still be making payments and helping to reduce the cost of this type of program and leaving resources for other types of financial aid, like increases in Pell Grants. And we can look to Australia, who's had a very long-running, I think, viewed in Australia as being successful income-driven loan repayment scheme that has really worked for a lot of their borrowers. And so I think that is, both a realistic and sort of not incredibly inferior alternative to large-scale loan cancellation.
Okay, anything to add, Michelle?
Well, I've been asked in a comment to make sure that everybody understands what a last dollar scholarship is. So I'd like to just take a moment to do that and explain that these place-based, these promised scholarship programs, most of them are awarded after other forms of grant aid are awarded. So if you have a scholarship program that allows people to go to community college, and many of those people are low income and qualify for Pell, their Pell Grants are going to be applied first, and the scholarship program is not going to bring them any new dollars because these scholarships generally cover only tuition and fees. I do want to say, I think that across the board student loan cancellation is highly unlikely, but I know that our presidential primary system is going to kick off shockingly soon, and the question of a national free college program is going to be out there, at least among the Democratic presidential candidates. And I think that once you start talking about tuition-free college going forward, you start to feel a lot of pressure around those people who already took on debt and are facing these repayment problems. And so I do think the policy landscape could shift a little bit with conversations around nationwide or a kind of federal state shared promise program.
Okay, thank you. Let's try to see if we can get 2 more questions in.
Can you please explain how income-driven payments are established? Are the repayments based solely on income, or is this inclusive of the cost of living?
Who wants to jump in with that one?
This is Kristen. I can take that. Income-based loan repayment, it depends on one of the many federally sponsored payment plans that you're in, but typically it's 100. So you start making payments at 150% of your adjusted gross income, and 150% above the poverty level. And from that point on, which for a single person is, I think, about $20,000, you're making essentially 10% of your income above that amount. The period of repayment that you're making, I think under repay right now for an undergraduate would be over a course of 20 years, and for a graduate student, 25. If you make below that 150% of poverty threshold amount, you are eligible for zero payments, so you get credit for that payment, but you don't have to make a payment on your loan.
Okay, do we have time for one last question?
This is kind of building on the previous question. Are there any post-secondary institutions offering any innovative IDR programs to students?
Again, I open it up to the panelists.
I can take this one. So there's a type of financial product that is in some way similar to income-driven repayment, called income share agreement. So this is similar in that it involves making a payment that's a certain percentage of your income for a certain number of years. It's different in that there's no balance. So there's no loan that you're paying off. It's instead a contract that you enter into in exchange for funding for your education. And oftentimes there's a cap on the total amount of payments you can make, but you're not paying down a balance. And these have been very popular sort of theoretically among economists and finance types, but just a few years ago, Purdue University started offering income share agreement contracts as an option to their borrowers that had exhausted their federal student loans. So for students who had maxed out their federal direct loans, they often would have to turn to more expensive private loans, or their parents would have to take out plus loans. And Purdue offers these income share agreements as an alternative to these other types of products to finance education. And the program is very new. There definitely has been interest in other colleges and universities in establishing similar programs. It seems like at Purdue, students are interested in this option, and there's sort of interest that's spread across all different majors. And so we will be watching to see, how these programs go and how the students fare as they move forward into the labor market.
Thank you, Leslie.
Thank
and
you.
With that, I think we've run out of time.
We have. Thank you very much for everybody who submitted a question. I'm sorry we didn't get to all of them. On the slide that I just put up, there are email addresses for our moderator and all our panelists. If you do want to ask a question directly to them, you can reach out by email. And as Michelle mentioned earlier, there are resources, some references to articles that were mentioned during the presentation, should you want more information. And thank you very much to our moderator and our panelists for all their knowledge today. It was a great event, and we hope that we see you at a webinar soon through APPAM. Thank you very much. Bye-bye.
Thank you, everyone. Bye-bye.